I published a new blog post last Thursday, June 18th, 2026, discussing some of my recent trades. A link to my blog post can be found in my profile section here at YouTube. I started to publish post in October 2008. I mentioned in a comment to that post that my meager stock allocation, which is currently less than 10% of my total assets held in 4 brokerage accounts, has been demonstrating this month negative correlation with the S&P 500. If the market goes down a lot, as it did today, my stock allocation is going up in value, with a total unrealized gain today in 2 of my accounts at over 2,000. I only checked 2, the Fidelity and Schwab accounts, to come up with that number. That result is caused by having almost no exposure in the technology stocks that cratered today, primarily in the chip sector, and owning dividend-paying stocks of reasonably valued companies, in my opinion, primarily in the equity REIT, regional bank, and consumer staple sectors. My focus now on stocks is primarily on buying dividend-paying stocks which have yields in excess of 4% at my purchase price, although I do make exceptions to that general guideline, and that are within what I consider to be reasonable valuation ranges, and many of them are in bear markets. I've been paring my exposure to REIT and regional bank stocks into their rallies recently, primarily by selling my highest cost shares profitably, which lowers my average cost per share, increases my dividend yield, and reduces my overall exposure to stocks. I did not buy any bonds prior to 2007, when I started to buy a small number of them, which was around 50 that year, as I recall, with proceeds from stock sales as I became increasingly uneasy with stock valuations. Less so now, and roughly equal to the concerns in 1999. I probably own over 400 corporate bonds now, and add to that number municipal bonds issued by Tennessee entities, treasury bills, treasury notes, and a very limited number of CDs. I like the fact that I can precisely know my total return to the penny with a bond purchased. Of course, that never happens with any stock purchase, and that assumes no default by the bond issuer. The weighting is short term, with I manage in the 2 to 2.3 year range, which reduces my interest risk exposure. The large allocation that I have to treasury bills shortens the duration that otherwise would be higher without those treasury bills. I bought 5 of the 2-year treasury note today that had a 4.19% YTM, if memory serves, which is my first purchase of a treasury note at auction in a while. To buy a treasury note now that's short term, that means the 2 to 5 year treasury notes, I need at least a 4% YTM, or I'm not going to bother with them. The traditional valuation indicators that I use and have over the years and have served me well over decades now are at or near or higher than they were at the 2000 market peak. I recognize that these valuation measures are not market timing indicators, since a stock market can remain overvalued and continue a parabolic spike higher even when it's well into what I would consider bubble territory as now. And that can continue for an extended period of time. before something triggers a massive valuation reset, something on the order of 50% or so, as experienced in March 2000 over the next 2-year period ending in 2022. One indicator that is far higher now than in 2000 is what is called the Buffett indicator, which is the market capitalization of the Wilshire 5000, the total U.S. stock market, to the U.S. GDP. That indicator topped out close to 140 in 2000. When I last looked earlier this month, the Buffett indicator was at 236%. Another valuation metric, which is not a market timing measure, is the Shiller PE, which is close now to where it topped out in 2000. There are justifications for a higher valuation for the S&P 500 now than in 2000, as I've explained and discussed in the past, since there are more large companies now with high profit margins that did not even exist 26 years ago, or so insignificant then that they did not matter. Still, what you have are extreme valuations for many of these companies now that build into the current price, in my opinion, a continuation of those profit margins for a decade or more. And only a few companies in U.S. history have managed to produce profit margins exceeding 20% over a decade. Microsoft may be the first one that I recall. What happens is that some product is introduced that generates huge profits and high profit margins. Then competitors, seeing that profit and profit margins, produce competing products, and maybe one or two of those companies come up with something better than the current leader. I am now about 2 weeks behind in discussing my investment grade corporate bond purchases. I have about more than 50 that I have not discussed yet that I've made today and prior to today that have not yet been discussed. Yield for corporate bonds maturing in 2028 have gone up in response to the somewhat hawkish Fed commentary in their last week that emphasized price stability, meaning fighting inflation. And fighting inflation for the Fed means raising the federal funds rate. Since I live in Tennessee, that does not have a state income tax, and that's important to me, the after-tax yield of corporate and treasury interest payments are the same. States with income taxes will tax corporate bond interest. So that reduces any benefit in the yield that they have over similar maturities in treasuries. I like the 2028 maturities now since they have the best combination, in my opinion, of a low interest rate risk and maturing in less than 2 years while capturing most of the yield of longer dated bonds. My portfolio is nowhere near a growth portfolio and is not going to produce the kind of results needed by someone much younger who needs to grow capital at a far faster rate than I do now. I just need to produce enough income to pay my bills after tax, with the goal being having about half of that income after expenses and taxes to reinvest, which I am meeting that goal each year now. Consequently, I have not taken any money yet out of my retirement accounts and will probably never do so. They will be passed intact to my heirs. Those are the last funds that I would tap to pay expenses. My portfolio is designed for me in my personal situation and my financial condition. It is an extremely conservative portfolio that I have, and I'm not going to lose any sleep or have the fidgets or suffer any anxiety if the market goes down 30 or 40%, as long as my bonds continue to pay their interest. I also manage my stock allocation in a way to mitigate risk, which I go through each week in my blog post that you can see what I'm doing. And yet that is still the riskiest part of my portfolio, even though it's less than 10% and manage to mitigate risk. But that is where I'm at now, and I'm not going to change.